So what you
somebody could
mean
get-
by that is the private lender is putting into their budget that you're probably not going to pay them back.
Correct.
And the bank is not as worried about that.
We want to get paid back every time, and we underwrite hoping that happens.
Yeah.
Which is why our interest rates are better than if you were to go get some private lender to make a loan on
And
your
probably
project.
a result of that is that you're looking at more straightforward deals.
Correct.
You're not taking major gambles.
Right.
with
We like
something.
more middle of the fairway deals.
Okay.
But generally speaking, we look for three sources of repayment. That's kind of the infrastructure of every credit approval memo, probably in the country for any bank. Always like to look at the primary source of repayment, which is most times going to be ongoing cash flow.
So it's rental income, maybe.
Rental income, if it's a piece of rental real estate, if it's a business or a business line of credit, it's going to be the cash flow of the business. If it's a big multi-tenant commercial property, it's going to be, what is all that cumulative rent less ongoing vacancy or normal vacancy.
So intended use of the property or of whatever you're lending.
Exactly. And in some cases, if it's a spec home or if it's a short term, it could be a sale of an asset, sale of a property. But typically that's the primary source of repayment.
Okay.
Secondary is typically the principal support. So if for whatever reason there was a shortfall of the primary source of cash flow, what's the ability of the owner of that business or that property to cover a note for a period of time? We don't expect that they can cover it forever. Obviously that would be nice, but do they have a little bit of wherewithal to jump in and make that note whole or pay the monthly payments if they had to? And looking at those contingent liabilities.
So already we're almost opposite of what a traditional residential deal would be.
Exactly.
In residential, your primary would be the borrower.
Personal.
Yeah. They're using this personally. They're going to pay it back personally. And then secondarily, you might look at some of the other income. Okay. All right. So we've got your primary source, where the money is coming from within the business or the property. Secondary would be who's signing a personal guarantee.
Right.
Who's going to write the check if that doesn't work? What's the third?
Third would be the collateral situation. So in most cases, exactly, what's your piece of real estate worth? Not just today, but what could it be worth in a liquidation situation? What is it worth, with a 20% market correction? And that's real estate.
That's not a real thing, is it? No, it doesn't happen.
I don't know. We all remember those days, don't we?
Yeah,
Hopefully we don't get back there again.
No kidding. No kidding. All right, so that makes sense.